As we saw in the previous chapter, there can be significant taxes attached to investing. And what we're going to begin in chapter 11, which we will continue over the next few chapters, is to try to figure out a way to avoid some of the taxes that typically come from investing. Specifically, we're going to learn about tax shelters. And what a lot of tax shelters have in common is a decision you need to make at the onset of whether you want your contributions to go in traditional or Roth. But before I show you that, let's take a look at what taxes look like if you don't use a shelter. So most of the folks watching this video, I assume, will have traditional jobs where they earn income from their employer. Right when they earn that income, right at the onset, there's going to be income taxes. And so that'll be the first time that your money is taxed. Okay? But unfortunately, if you're going to save that money, it's not going to be the last time that it's taxed. And there's various things you could do with that money. For example, you could put it in a savings account. If you put your extra income, your savings in a savings account, unfortunately, the earnings that that savings account generates will be taxed as income. If you instead put it in stocks or bonds, that also will be taxed. Most of us are going to take most of our money and put it into stocks, hopefully, because that generates the highest expected return. And let's see what that would look like if you took your income now, took aside a portion of it and saved it, and didn't touch that money until retirement. So you're going to effectively take that money that you're earning now when you're, 25 years old. You're going to save and invest that money, and you're not going to spend it until you're 65 years old. So effectively, some of the money that you earn today is going to be spent during retirement. That's the major part of the financial planning game, isn't it? To try to take your earnings now and put it into the future so that it can allow us to retire. That's probably the key part of financial planning, is planning for retirement. So we need to have money saved, and this would be one way to go about it. Now let's think about how often that money would be taxed. It would be taxed right when you earn it, and then when you put it into a brokerage account, you're now going to start earning some dividends. And every time you earn a dividend, it's going to be taxed. Most of the time that'd be taxed as capital gains, but we're talking every so often that money is going to be taxed. On average, companies pay out about 1.5% of the basis you deposit in dividends annually. So every year it's like you have to pay maybe a 1.5% tax on that money. 1.5% isn't a lot, but it's 1.5% annually for the life of your investment. So it's like you'd have to pay a 1.5% tax every single time you earn a dividend, 1.5% per year. So this may end up being tens or even hundreds of thousands of dollars in dividend taxes that you have to pay. Perhaps, okay? Depends on how much you're spending, but maybe I'm exaggerating the point there a little bit, but the bottom line is there's a lot of taxes to consider. So you're going to be paying dividends along the way, and then the major tax that you're going to have to pay is upon withdrawal. When you withdraw that money, you're going to get taxed again as capital gains, and that will be based on the profit that you've generated on that stock. And if you've held stocks for 40 years, as you have in this example, there's going to be a lot of profit generated, and thus a lot of wealth there to tax. So the bottom line is, if you don't use any sort of tax shelter, there's going to be various taxes that you have to pay. This is not ideal, and for most of us, it is avoidable. So what we would like to do as our goal is to pay taxes on our earnings once or not at all. All right, and paying no taxes on your earnings is pretty tricky. There's not that many ways to do it, but we're going to see at least one easy way to do it via a health savings account. But most of the time with our tax shelters, what we're trying to do is pay taxes only once. Specifically, we want to either pay taxes when we earn that money, or we want to pay taxes when we withdraw that money from retirement. But we don't want to pay it twice, and we don't want to pay all the taxes along the way as well. So we're trying to avoid these types of multiple tax situations that we could face in a brokerage account. So, when you have a tax shelter, like 401ks, which is going to be the first one that we discuss in length. The 401k is a pretty straightforward tax shelter, and it's similar to a lot of the other options that you have available to you. 401ks are offered to you by your employer, and generally it's only for-profit businesses that offer a 401k. But that is the vast majority of employees in the United States are employed by a company that offers a 401k. So when you get that 401k, generally you're going to have a choice. You've got your shelter, then there's going to be the option of whether you want to go traditional or Roth. And we want to compare those two options. So when you set up that 401k and you start making contributions, immediately a choice you're going to have to make is whether you want it to be traditional or Roth, okay? So let me explain the difference there. Let's start with traditional, okay? A traditional account avoids taxes now when that income is earned. A traditional account avoids taxes now when that income is earned. So for example, let's say that your salary from your job is $70,000 and you contribute $5,000 to a traditional account, like a traditional 401k. Now the government is going to view your income situation and say, look, let's pretend as if that $5,000 doesn't even exist. And now your income is actually going to be $65,000 in the eyes of the government. Now, how much money does that save you? Well, it depends on how much income you have, because tax brackets vary based on income levels. For someone in this situation, they are in the 22% bracket. So what that means is, by reducing their income by $5,000, they're going to save 22% of that, so their taxes would go down by $1,100, and you can check the math on that, okay? So this is what a traditional account allows you to do. You put money in, it reduces your taxable income, and in doing so, it reduces how much taxes you have to pay, okay? If we think about this on a life cycle model now, what you've effectively done I'm kind of drawing this like the last example we had. If we think about what a traditional account allows you to do, is it allows you to earn income tax-free. That $5,000 that you earn, you still have it. It's yours. It's just now in an account. It won't get taxed at all at the time of earning. It won't get taxed at all while it's still in the 401k. And when you withdraw from that account, that is when you finally will actually have to pay taxes. So if you put $5,000 in your 401k and upon retirement there's $30,000 in that account and you withdraw it all of that money is going to be taxed as income. Not just the profit, unfortunately. All of it will be taxed, okay? So you still get taxed, but you've eliminated this down to only one time that you're having to pay taxes. And this can save you quite a bit of money over the course of your life. You know, proper management of your income here, we're talking $100,000+ in savings just from the taxes that you avoid, okay? So a traditional account allows you to avoid current day taxes on your income. Or alternatively, you might decide to use Roth contributions. Now, Roth contributions allow you to avoid future taxes. So let's say that your income, again, is $70,000, and you contribute $5,000 now to a Roth account, like a Roth 401k. From an investing standpoint, this doesn't change too much. You're still going to have your money go into a 401k. You get to choose how it's invested, and it can grow through time. But from a tax standpoint, this is treated totally differently, okay? The government now will actually look at your situation and say, okay, this person earns $70,000. It doesn't have any impact on your current taxes. So why would you want to do it? Why would you want to put money into a Roth 401k if it doesn't save you any money in taxes? It does save you money in taxes. It's just that tax saving is deferred, okay? So here's how it looks on a life cycle model. So again, you're making those same choices. You're earning money during your younger years, and then you are investing that money over time. And then during retirement, you're going to need to access that money, withdraw, and spend it. What a Roth IRA allows you to do is to choose to get taxed now while you're working. So that $5,000 still gets taxed. So you still get taxed today. But since you put that money into a Roth account, it never gets taxed again, even when you withdraw it. And you can kind of see how this is clearly better than what you would do with a brokerage account, right? If you put money into a brokerage account, all of that money is taxed as income, and then it's going to be taxed when the dividends roll in, and it's going to be taxed when you sell and earn a profit. So you're going to get taxed a bunch of extra times. With a Roth account, you still pay taxes on your income, but none after that. So you're going to avoid all of that future taxes that you could have been forced to pay. So proper management of your money goes a really long way, because what some people will do, people who are not financially savvy, is they will just spend money and just look at their bank account and say, oh wow, look at me, I've got some extra money in there. And then they'll start putting money into stocks. They're not planning ahead, and they're not able to use a tax shelter, okay? So if you look in the book, freefinancebook.com, this is chapter 11. I do, I think, a really good job of comparing and contrasting the three methods that you could use here. 1, a brokerage account. 2, traditional accounts. Or 3, a Roth account. So look there for a lot more detail. Now, when it comes to choosing between traditional and Roth accounts, this can get pretty complicated. It's pretty obvious that you want to use tax shelters when you can, right? I mean, the benefit of a tax shelter is you're avoiding taxes. We want to avoid taxes, right? But we've got some considerations to make to decide, do we want our contributions to be Roth or traditional? So one thing to consider is how your income changes over time. So as an example, compare two people, somebody who makes $70,000 and somebody who makes $1 million in income from their jobs. The tax bracket that they are in is very different. For the person who earns $70,000, they are in the 22% tax bracket. So any contributions they make to a traditional account is going to save them at the 22% tax bracket. Alternatively, somebody with $1 million in income, they are in the 37% tax bracket. So who has more to gain from traditional investments? The person with the higher income, right? The person with $1 million in income, if they put $1,000 into a traditional account, they're going to save $370 in taxes. Whereas the first person would only save $220. So income plays a role. But it's not just based on your income today, it's also a function of what you think your income is going to be in the future, okay? So here's generally what I recommend. If your income is going to rise in the future, what do you think? If your income is going to be higher next year and the following year, it's going to rise in the future, do you think that should make you more or less likely to use traditional accounts today? Should you use traditional or Roth accounts today if you think your future income is going to be higher? Well, ideally, you'd like to have a mix of both traditional and Roth accounts. That will allow you more flexibility down the line. So you have to think into the future and think about what your life is going to look like. Okay? So if you think your income is going to be higher in the future, 10 years from now, do you want to be making traditional or Roth contributions? 10 years from now, your income is going to be a lot higher. So 10 years from now, it might make more sense to make traditional contributions to avoid that high tax bracket that you face. Today, you're in a relatively low tax bracket. So if it makes sense to go traditional in the future, it probably makes sense to go Roth today when you're in a relatively low tax bracket, okay? And this is what happens for a lot of new employees, like college graduates. That first job you get out of college, I would recommend you put 100% of your income into your Roth investment options that are provided by your employer. And the reason for that is that first year that you work is probably going to be one of the lowest salaries of your entire career. You're going to be in a low tax bracket. Since you're already being taxed at such a low rate, you should go ahead and choose to pay taxes now since your tax rate is so low. And then in the future, when your income is a lot higher, then contribute to traditional accounts to avoid those high tax brackets that you face then. In addition to just general income changes, I give a rule of thumb in the book, which is if you're in the 10 or 12% tax brackets, I would always contribute to Roth accounts. And that's because the lowest tax bracket you can ever face, ignoring things like deductions we're going to talk about in the future, but the lowest tax bracket you can face is 10%. So if you're in the 10 or 12% tax bracket right now, I would say go ahead and go Roth, because that's basically the lowest tax you could ever face. So you should go ahead and pay those taxes now, because in the future you might be in a lot higher tax bracket. Okay? Related to that idea of income changes is also retirement, and I'll list this out as a second scenario here, or a second consideration. If you think you're going to retire early, should that make you more or less likely to use traditional or Roth accounts now? Okay? Let's think about what this looks like. When you're 52, 53, 54, and so forth, your income as an early retiree is going to be $0 or close to it. Okay? Now, you're going to pay taxes when you withdraw from those accounts if it's traditional. So here's your choice. Okay? If right now at age 22 you're earning $100,000 and at age 52 you're earning $0, you basically have a choice of when you want to pay taxes. Would you rather pay taxes now when you're in a pretty high tax bracket, or would you rather pay taxes in the future when you have no income at all? You'd rather pay taxes here, because here is where you're going to face the lowest tax brackets. So the strategy to employ would be today when you're 22 to make traditional contributions. So for example, you might put $20,000 into a traditional 401k. That now leaves you with $80,000 in taxable income. And then in the future, when you're retired and you need money, you then can withdraw from traditional accounts. For example, you could withdraw $80,000 from your traditional account, and now you're being taxed at the same level when you're working as when you're retired, which is generally going to be quite efficient. Okay? What you don't want to be is in a scenario where you're taxed at $100,000 in the past and then $0 today. That's very tax inefficient. Okay? Now, 401ks can be tricky to get your money out at age 52, but we're going to learn about tax shelters that have some ability to take money out at really just about any age. All right? So what you've learned so far is if you think your income is going to go up over time, it makes more sense to use Roth contributions today. And if you think you plan to retire early, that means you're going to have a bunch of years with no income. It makes generally more sense to contribute to traditional accounts today. As a third consideration, we need to think about future tax rates in general, not just the tax rate you face, but the tax rates that are levied by the federal government. So in the future, what do we think is going to happen to tax rates? Right now, it's really hard to say, but a lot of economists think that if tax rates are going to change in the future, they're more likely to go up than down. The logic of that is the federal government has tremendous amounts of debt, and if it ever wants to get out of that debt, it's going to have to start raising taxes. So if we expect the U.S. government to raise tax rates in the future, should that make us more or less likely to use traditional accounts today? Less likely, okay? Remember, if you put money into a traditional account, you're avoiding today's taxes. But in the future, when you withdraw, you're going to have to be taxed on that money then, okay? So if you expect tax rates to increase over time, this makes Roth investments better today. And in reality, it's not like just one of these is going to make your decision for you. There's some nuance here. Maybe you think there's a 30% chance you're going to retire early. Maybe you think there's a 60% chance that your income is going to be flat. It really depends on your situation. It's hard to know what the future is going to look like. But there is one category where the Roth account is really clearly better, and that is in regards to flexibility. I'm running out of room here, but I'm going to try my best here to explain it. Let's say that you would like to withdraw $1 million during retirement to buy a beach house. That's always been your dream, is when you retire, you're going to buy a $1 million beach house and go move to the coast. Let's think about whether it would be easier to withdraw from a traditional account or a Roth account. If you withdraw $1 million from a traditional account, you're going to get taxed as if you have $1 million in income. That's bad times. That means you're going to face very high tax rates, okay? So if you take a bunch of money out of a traditional account all at once, you're going to face substantial tax rates. On the other hand, if you withdraw $1 million from a Roth account, you're going to face no taxes. Now that money has already been taxed, so it's not like you avoided taxes entirely. It's just the taxes are behind you, and you can now take all of that money out tax-free. So from a flexibility standpoint, a Roth account is better because you can make big withdrawals without any sort of concern for the tax implications that you might face, okay? So apples to apples, if I could have money in a traditional or a Roth account, all else equal, I'd rather have it in a Roth account because it does provide additional flexibility. But apples to apples doesn't exist. In reality, we have a lot of things here to consider. I can tell you from myself personally, I made some kind of bad choices regarding traditional accounts. When I was like 30 years old, my wife and I, our combined income was maybe, $180,000. And we were loading up our traditional accounts. And the reason for that is we figured there was a pretty good chance that my wife, maybe around age 33, she would quit working and just stay at home with the kids. And our income, would be cut roughly in half. But that didn't happen. Instead, we both ended up working. And so planning for this, what I did is I made fully traditional contributions when I was 30 years old because we expected that would be our really high years of earning, right? When you're making $90,000, it makes more sense to put money into a Roth account than when you're 30 years old. In this scenario, it makes more sense to put money in a traditional account, right? When your income's high, traditional accounts look better. When your income's low, Roth accounts look better. But our future changed. In reality, our income just kept going up. And by the time we were 33, we were making, $200,000 or something. And at this point, we wish we had done more Roth contributions in the past, and there's no way to go back in time and make those changes. So basically what that has resulted in is we have a lot of traditional accounts, not a lot of money saved in Roth accounts. Not a disaster, but it is a planning mistake. So just to make sure that we understand this, I'm going to go through some examples. But first, let me just make one final recommendation, and that recommendation is in regards to diversification. This is something I wish I could go back and tell myself to follow. If you're not sure if you should do traditional accounts or Roth accounts, you're not alone. All right. When you're 28 years old and you're making $100,000, it's really unclear whether you should go traditional or Roth for most people. You don't know how many years you're going to work. You don't know what tax rates are going to look like, and you might not have a good idea of whether your income is going to go up or down in the future. So what I generally recommend is don't be afraid to contribute to both. It doesn't have to be 50-50, but you can have a mix. Like, for example, let's say that your income is $100,000 and you figure your income's probably going to go up over time. You're probably not going to retire early. These things point towards using Roth contributions today. But the future is uncertain, so maybe toe the line a little bit. Maybe go 80% Roth and 20% traditional. And in doing so, you're giving yourself some diversification. Just like diversification is good with investing, this is a form of diversification. Effectively, the tax rates you face will impact your effective interest rate that you generate from your income. So what you're doing here is you're towing the line a little bit and saying, look, I'm not exactly sure what the future looks like, so I'm going to be cautious and I'm going to do a little bit of traditional and a little bit of Roth. Now, how this could be valuable to you is, let's say in the future it turns out that the government raises tax rates way up. Well, then you're going to be happy you have the Roth accounts. On the contrary, let's say that the government lowers taxes substantially in the future. Well, if they do that, then traditional accounts today are going to look much better because you're avoiding taxes now and income tax rates are pretty high. In reality, we don't know which of those is going to occur. So having a mix is good. Okay? Before I get you out of here, let me make one last note just to make sure we understand the tax implications here. Let's shape your life out here. Let's say you're 23 years old and you're making $70,000, and at 70 you're retired and making $40,000. Now, when you're retired, you're probably still going to have some earnings through Social Security, maybe through pensions. You could be a part-time worker. There's probably still going to be some income that's generated there. So in reality, $0 incomes are pretty rare, especially once you get to the Social Security age. So this could be kind of where your life looks. You know what you're earning now. You know there's some retirement in the future. The in-between is a lot more confusing, right? So let's just make sure we understand what traditional and Roth accounts would look like. Let's say when you're 23 years old, you put $10,000 into a traditional 401k. When you do that, your taxable income now is going to be $60,000, but that income tax doesn't go away. It's just going to be pushed forward into the future. Now, this $10,000 is going to grow, and by the time you get to age 70, maybe you've got $180,000 in your 401k. Now, you are not obligated to withdraw that money, at least not all of it. Once you hit a certain age, there are things called required minimum distributions. You do have to take some money out, but at age 70, you don't. It's just a choice. So at age 70, you'd be looking at that money and just trying to figure out how much do I need to withdraw, if any. Let's say that you decide to take $40,000 out of that, right? You've got $40,000 already, but you need an extra $40,000 to survive. Now the government is going to tax you as if your income is $80,000. So all of that $40,000 is going to be taxable. It's not just the profits that your 401k generated. All of that money is going to be taxed. The logic is none of it was taxed to begin with, so all of it needs to be taxed as income today. So there's no capital gains to worry about. When you withdraw from a traditional account, it's taxed as income. All of it is taxed as income. Comparatively, if you put that money into a Roth 401k, keep in mind when it goes into a Roth 401k, your income is all going to get taxed. All $70,000 is going to get taxed. And kind of a subtle thing is actually it's harder to put $10,000 into a Roth account than into a traditional account. $10,000 into a traditional account is just $10,000 in income. But to put $10,000 into a Roth account, you actually need more money than that because it's got to get taxed first. So it might take $14,000 to get $10,000 into a Roth account. Okay? So you take $10,000, put it into a Roth 401k, it grows to $180,000. When you're 70, you withdraw $40,000, that's not going to get taxed. You're still only going to get taxed on that $40,000 in regular income that you generated. So with Roth contributions, you don't impact your taxes today at all, but you avoid future taxes. And all of this relates only to income, okay? None of this is impacted. None of this has any impact, direct impact on Social Security or Medicare, okay? So if you put $10,000 into a traditional or Roth 401k, that is not going to have any bearing on your Social Security or income tax or Medicare taxes, okay? So your Social Security taxes will still be based on $70,000 in income. Your Medicare taxes will still be based on $70,000 in income. So this content that we're discussing here is only relevant for income taxes. It doesn't have any bearing on Medicare or Social Security taxes. It's a lot to consider, right? This is getting pretty complicated. So I would implore you to read the book carefully, work through the practice problems that you will find in chapter 11 of my book, freefinancebook.com. Go check it out. You got to learn this material, because when we get to the next chapter and we specifically hone in on the rules of 401k, you're going to be lost if you haven't understood what we're talking about right now. Good luck.